Hi folks, welcome back to the final part of this video. What we're going to do is we're going to try calculating some of the financial statement amounts for 2016 and 17. So the first thing I'm going to do is I'm going to do both 2016 and 17 assuming that we used with recycling, meaning that any unrealized gains or losses that accumulated on any of the fair value through OCI investments that we ultimately sold went to net income. So now first of all, we didn't sell any investments until 2017. So if we just went down the 2016 column, that's why we would see that in the other revenue and expense area of the statement of earnings or income statement, there's nothing in there as a result of this investment because we didn't sell anything in 2016. You remember it was until February 2017 that there was a sale. So how is that going to affect our statement of comprehensive income? Well, again, I just assumed, to put a number in there so we can get a number for comprehensive income, that income was $100,000. That's your net income. But what would have happened in the OCI section of the statement of comprehensive income? Well, first of all, what I would have done is I would have said here, well, we have OCI, so what we want to do is look at what we booked this year in terms of unrealized gains or losses just during 2016. And in this case, we know it's $4,200 because we had a fair value at the end of 2015 of $32,200 and now it's $36,400. That difference is your $4,200, right? So that's what we would have booked. If you're not sure, you can always go back to your question and find it right there in your T account if you used a T account, or you might find it up here when you did your entry at the end of 2016. So wherever you want to get it from, but as long as you realize that it's the unrealized gain or loss that was booked during this current year, which is 2016. Now, how much of that was recycled back into net income? None of it, because we didn't have a sale this year. Notice in 2017 we do have some activity in these accounts because that was the year the fair value through OCI investment was sold. So in 2016 we'd have comprehensive income of $104,200. In the statement of financial position, we can go back to the question and see that our fair value through OCI investments, which again are a long-term investment, which puts them in the non-current assets section of the classified balance sheet, would be sitting at $36,400. That's our fair value of the investments, again from the question, at the end of 2016, which is the year that we're in. What about our balance in AOCI? Well, again, we can calculate that quite simply. We did it earlier in the T account. I think we did anyway. Did we have a T account for AOCI? Yes, we did. We had it here at the end of 2016 when we tracked all the unrealized gains and losses that went through. Right? That was an unrealized gain, an unrealized loss, the subtotal, then an unrealized gain, and then we had a net balance at the end of 2016, a net debit balance of $3,500. Right? So you could have got it from there. The other thing you could have done if you wanted to, and that's what I've done here. The other way you could do it is you could look at your AOCI balance from the beginning to the end of the year. And we know that if the AOCI balance at the end of 2015, i.e. the beginning of 2016, was $7,700. And how do we get that? Well, again, you can go back to your T account if you want. $7,700 was right in here. It was your $1,850 credit, okay, less your debit of $95.50. We put that in, and again, if at any point in time, don't forget your AOCI balance is the difference between what you paid for the investment when you bought it and the fair value at the date for which you're calculating AOCI. So AOCI at the beginning of 2016 is the same as at the end of 2015, and that's your $32,200. So that's how we get negative or a debit balance in AOCI of $7,700, which we've again shown in our T account. So that would be that, and then look at what we put in it during the year, which we already know from our statement of comprehensive income, right? Our OCI this year in total was $4,200. So that's going to be added in here to give us a balance, a debit balance of $3,500. If we turned our attention now to 2017, we know that because this is the year that a fair value through OCI investment was sold, and we know that the unrealized holding loss on that was $1,900, that holding loss is going to find its way in through the realized loss in the income statement because it's with recycling, and it's going to be $1,900. Again, if you're not certain, you can go back right here to where we did it, and that loss was in your step 3. Okay, so now, and that might be something you didn't realize. Again, that loss and how it gets into income is by what you do in step 3. So whatever you do in step 3 is what you should have in your statement of earnings if it's with recycling. Now, if we go to our statement of comprehensive income, now that we've sold the Fahad investment, we have to say, well, we want to look at all the cumulative gains and losses that we've been holding on this investment and adjust them out of OCI because they've now hit the income statement. So we know we had unrealized gains and losses this year of $1,600. Again, this is 2017. How did we get that? Well, again, if you go back to your, where am I, 2017. So if we go back to what we did in 2017, we put an unrealized gain or loss credit, which is an unrealized gain of $1,600. So that's what we recorded this year as a result of the adjustment to fair value. So we put that much in it, but don't forget we also recycled, okay, an amount to net income. And don't forget, so we deduct from this what we recycled to net income. And don't forget we recycled or deducted, that's your less, you deducted a loss. This was a loss, right? Because remember, we had the unrealized holding loss was recycled as a realized loss into income. So this negative in front of the 1900 I represent as a loss, right? And what I do here is just bracket it. So these brackets aren't for the less, they're because of the fact that it's a loss that I'm recycling. Okay, so 1,600 minus a negative, which is plus a positive, is going to give me OCI for 2017 of 3,500, and I'm going to use that to update my AOCI balance. But in the meantime, what I have is comprehensive income of 1,035. So now if I go to my statement of financial position, because my investment at the end of 2017 has been sold, in fact it was sold in February of that year, I don't have a fair value through OCI investment anymore, so it's 0, and my AOCI should be 0 as well. If I don't have an AOCI investment, I shouldn't have any AOCI, but I can prove it because I know that at the beginning of 2017 I had a debit balance in AOCI of 3,500. How come? Well, because that was my balance at the end of 2016. So this balance, because it's a balance sheet account, becomes my opening balance for 2017. So again, my ending balance of 2016 becomes my opening for 2017. And we already said that during the year we booked an OCI gain, right, at net. $1,600 gain from which we removed a loss, so we removed a negative number. So now we've got 3,500 positive, which is a credit. So negative 3,500 plus 3,500 is going to give me 0, which it should be, because I don't have an investment. If I don't have an investment, right, I shouldn't have any AOCI, right? So, because every time I get rid of an investment, I have to clear out any of the OCI that's related to it, and all the cumulative OCI on it would be sitting in AOCI. So I shouldn't have any of that left if I don't have a fair value through OCI investment. Now, hopefully you guys are okay with that. If not, play the video again, take your time, rewind it, go through. Okay? When you're ready, we'll go on to the next part, and what that is going on to looking at what the statements would look like in 2016 and in 2017 if we did it without recycling. So instead of recycling any of the unrealized holding gains and losses into net income upon the sale of a fair value through OCI investment, it's only going into retained earnings. So now you can see that in either year, no matter what year, we would have no effect on the statement of earnings because, first of all, for 2016, there was no investment sold that year, so it's not applicable. And in 2017, there was an investment sold, but it didn't go through net income because this is without recycling. So your statement of earnings or income statement isn't affected. But what you notice is that regardless of whether it's with or without recycling, there is absolutely no change in comprehensive income when you compare 2016 without recycling, 1042, to 2016 with recycling. 2016 with recycling, it's the same. Why? Because you still had the same unrealized gain or loss during the year. It was $4,200. Again, don't forget, it's the difference between your fair value at the end of 2015 and the fair value at the end of 2016. That's your $4,200. And we didn't reclassify anything to retained earnings during the year because we didn't sell anything during the year. So that's zero. So $4,200 less zero is still $4,200, right? If you compare what we did in 2017, again, we still get 103.5, just like we did up here, even if it was with recycling. It wouldn't matter. It was the same thing. Why? Because we still had an unrealized gain, holding gain during the year of $1,600, right? That was your step one, right? Let's go back up here just to make sure. Okay, you're following along. That was your step one. When you updated your fair value through OCI Investment to the fair value at the date of sale, you booked a credit to the unrealized gain or loss account, which is a gain, okay, of $1,600. But don't forget, you were also holding on that Fahad investment a holding loss cumulatively of $1,900. And we showed you how we calculated that before. The same way we did it here. It's no different. It's just going into, in this case, retained earnings. But we calculated it up here. We said it was the difference between what we paid for it, $39,900, and what we sold it for, which was $38,000. And again, we were tracking it. You can get it this way if you want to see that you have an unrealized gain or loss that's being credited. And in this case, it was debited $1,900 to the loss. But, and this is where the T account is, but all we're doing when it's without recycling is saying, well, we'll put it to retained earnings instead of the loss. So instead of putting it into income without recycling, put it to retained earnings. So it's the same logic. But if you prefer to use the T account to show you what's going on in the unrealized account, you can. All we're doing is tracking it through all the unrealized gain for 2014, the loss for 2015, gain for 2016, and the adjustment to fair value just before you sell it at $1,600. So therefore, if we net out the debit from the credit, we're going to get an unrealized gain or loss debit, which when we clear out to zero by crediting that account, because we're doing without recycling, we're going to debit retained earnings this time. So therefore, that's why you still have this adjustment, right, that you're making because you're recycling it now to retained earnings. Sorry, wrong page. Retained earnings, right? So that's going to be $3,500, which is still going to give you in comprehensive income $103.5. Now don't forget, this is the amount that's going into AOCI. So, and this is the amount for 2016 that will be going into AOCI. Same thing. So now we have the same. We would have started AOCI at the beginning of 2016 at $7,700. And again, if you're not sure, go back up to your T account or however you're calculating it. I always say the T account is good, but up to you. Depends how you want to do it. It's the difference between the unrealized gain that you booked at the end of 2014 and the unrealized loss that you booked because the investment went from $39,900 to $32,200. So there's your, that's your ending balance there. But to get to that ending balance, we must have debited it $95.50, right? And that was here. Comparing the value at the end of the year, which is $41,750 at the end of 2015, to what it was at the end of this is what it was at the end of 2015, and this is what the investment account balance was at the end of 2014. So at the end of 2014 compared to 15 gives me $95.50, right? So now when I get down here into my statements, again, that 1800 netted out against that 9550 is going to give me negative 7700 in my AOCI. I add in whatever I put into OCI this year, which is 4200, which gives me negative 3500. Carry that through to the beginning of 2017 with what got added to AOCI this year, which is exactly what I put into OCI, which is 3500. I get a zero balance. And again, it makes sense. If I don't have any fair value through OCI investments, I shouldn't have any AOCI on them either. So this concludes our presentation of the statements for this question. I hope you found it beneficial. I would highly recommend that if you're still having challenges with this concept, and I realize it can be confusing, that you print this document that we reviewed and that you go through the video again and try and make some notes on it if you haven't already done so. Some of you may find that you may be fine just going through the video again, but there is a lot of tracking and a lot of, taking your time with it so that you can know where the numbers come from.